If you're tired of paying too much in taxes, you might be making the same mistakes that most people do, like misunderstanding how tax brackets actually work. In this video, you'll learn how to legally lower your tax bill using deductions, credits, and smart strategies with retirement and investment accounts, so you can stop overpaying and start keeping more of your hard-earned money. Let's start with the basics. Tax refunds aren't free money. They're a sign that you overpaid the IRS throughout the year. Most employers withhold more than necessary so that you don't owe anything come April. But all that does is result in more of your money sitting in the government's hands interest-free. You layer in multiple income streams like salary, bonuses, company stock, maybe even a side gig. It's incredibly easy to miscalculate what you owe. Overpaying is common, but the bigger issue, most people aren't doing proactive tax planning throughout the year. They react in April instead of starting to plan in January. Here's a myth that we should put an end to in 2025. If you move into a higher tax bracket, it does not mean that all of your income is taxed at that higher rate. The United States uses a progressive tax system. That means that your income is taxed in chunks. So if you make $200,000, only the dollars in the top bracket get taxed at that rate, not your entire income. Knowing this helps you to plan better. It can mean the difference between taking a deduction now versus pushing it into the future in a potentially lower income tax year. If you've got a side hustle, stock options that are vesting, or you switch jobs this year, you should watch out. Each employer may treat you like you qualify for the full standard deduction on their payroll. That's a recipe for underwithholding and a surprise tax bill come April. And if you're self-employed or freelancing on the side, you might owe both income tax and self-employment tax, an extra 15.3% for Social Security and Medicare. So what's the fix? Work with a CPA or a financial planner throughout the year to calculate what you actually may owe. Then adjust your W-4s and start making quarterly payments. One of the most effective ways to reduce your taxable income is by using the IRS's own playbook. I'm talking about qualified accounts. Here are the key ones for 2025. 401ks and 403bs. The max contribution for 2025 is $23,000 or $30,500 if you're over 50. This directly lowers your taxable income, and many employers still make matching contributions. HSA or health savings account. If you're in a high deductible health plan, this triple tax advantage account allows you to contribute pre-tax, grow tax-free, and withdraw tax-free for medical expenses. Roth IRA or Roth 401k. You don't get a tax deduction for your contributions, but your money grows tax-free and you get to take tax-free withdrawals in retirement. These accounts are key for future tax diversification. The backdoor Roth strategy, which is still available in 2025 if done correctly. This is great for high earners who don't qualify for direct Roth contributions. The bottom line, use these accounts strategically based on your current versus future tax bracket. And if you're running a business or working as a contractor, you're leaving money on the table if you're not treating your business like a business. Here's what you can write off in 2025. Business meals are 50% deductible, software, subscriptions, phone and internet, mileage or other qualifying vehicle expenses, a home office if it's used regularly for your business, and most equipment purchases qualify under Section 179. Also, you can set up a solo 401k or SEP IRA, letting you contribute both as an employer and an employee. Depending on income, that could mean up to $69,000 in tax-deferred savings. Okay, now let's rapid fire a few advanced strategies. Rental properties. Depreciation can offset rental income and reduce taxes. Just know that you'll recapture it when you sell, so make sure you plan ahead. Hiring your kids or family. You can pay your kids to work in the business, and their wages may fall below the taxable threshold, and you can deduct those wages as a business expense. Spousal IRA contributions. If one spouse doesn't work, the other can still contribute to an IRA on their behalf. Spousal loans. A high-income spouse loans to a lower income spouse at the IRS prescribed rate, which is still very low in 2025. The lower income spouse then invests the money, which is great for income splitting. Charitable giving. Bunch donations into 1 year to exceed the standard deduction and itemize. Or use a donor advised fund to maximize tax benefits and donate strategically. Here are some tax credits to watch for in 2025. The child care credit, which is up to $3,000 per child, but income limited. The EV credit, which is up to $7,500 if buying a qualifying vehicle. Education credits, lifetime learning, or credits for tuition. Here's the truth. The tax code severely rewards those who plan. And if you wait until April to think about taxes, well, then you're just reacting. But if you start in January, then you can engineer a much lower tax bill. And while there are plenty of strategies out there, none of it matters if your financial foundation is shaky. Focus first on getting organized, automating savings, and then layering in the advanced stuff. The tax code isn't rigged, it's just misunderstood. But now you've got the blueprint. Start using these deductions, credits, and accounts the smart way. Do you want to cut your 2025 tax bill without the guesswork? Grab our free executive tax reduction checklist. The link is in the description below. Inside, I walk through 7 high-impact strategies for high-income earners with complex compensation. These are quick, actionable, and designed to keep more of what you've earned. And if this video helped you feel a little more confident about tax time and planning throughout the year, go ahead and leave a like and subscribe to the channel for more straightforward, actionable financial content. You've worked really hard to earn it. Now let's make sure you keep more of it.